What is going on, everybody? Hopefully, guys are doing well out there. On today's video, I thought we'd have a little bit of fun because we're heading into really one of the most fun weekends of the year, particularly if you're a sports fan, certainly if you're an NFL football fan, and that is obviously the Super Bowl. Now, being a Cincinnati Bengals fan myself, I've come to witness the Kansas City Chiefs numerous times over the past couple of years, really respect that organization and respect the players on the field. Now, on the other side of the ball, you have the San Francisco 49ers. And I just happen to be a proud season ticket holder of the San Francisco 49ers. So you can probably imagine which team I'm rooting for, but at the end of the day, a great game, some great food, and some great times with some friends and family always makes every Super Bowl I've watched a memorable one. But the urgent question, we have a very urgent question, and that is the companies that advertise on the Super Bowl, how does their stock perform over the next year after dropping millions of dollars to advertise on one of the biggest TV events of the year? Now, to decide this, we're going to take a look back at last year's Super Bowl advertisers and see which companies performed the best and which companies performed the worst. Now, as a whole, I found about 32 companies, and they're all publicly traded, some here on the United States Stock Exchange, some companies trade on other stock exchange. There's some companies like Comcast or maybe like Stellantis that advertise two different brands during the Super Bowl. But overall, I found about 32 different companies. And as a whole, if you had bought the basket of Super Bowl advertising companies last year, you would be up an impressive 23% on your investment over the last year. To give you some context, the S&P 500 over the last year is up about 21%. So the cohort of Super Bowl advertisers is actually beating the S&P 500 by just a little bit over the last year. Now, let's take a look at some of the worst performing stocks that advertised on the Super Bowl last year. The worst performing stock out of them all was Paramount Pictures, ticker symbol PARA. The motion picture maker and TV provider was down 45% over the last year, as a lot of traditional cable and streaming companies absolutely took it over on the chin over the last year. That sector just has not performed well. You can look at Disney stock as kind of the quintessential example of that, but Paramount and others have not performed as well. Now, also in that cohort is Warner Brothers, ticker symbol WBD. This stock was down 32% over the last year for basically the same reasons. Paramount, Disney, and others have not performed well. Also interesting, in some of the worst performing stocks over the last year that advertised on last year's Super Bowl are two alcohol makers. That's Remy Martin. Shares of that company down 39%. And you also had Crown Royal. Shares of that company down over 13%. Also included in poor performing stocks over the last year was Planters Peanuts. Shares of the parent company that owns Planters was down 33% over the last year. And also Reese's, owned by Hershey's, shares of that company down 18%. I think if you look at the alcohol makers and also Planters Peanuts and Reese's, what you have there is in an inflationary environment, you have their input cost, their raw materials that go into their product, also the transportation of that product as well. Those costs largely outpaced any pricing power that they had. Now, what you have to factor in, and what will be interesting to monitor over the next year, is if the reverse can happen. If we can have a disinflationary environment where input cost, like transportation, the raw materials, the peanuts, the stuff that goes into alcohol, if those raw materials can come down, can Planters, Remy Martin, Crown Royal, can they keep their prices the same and stretch their margin? That'll be interesting to see over the next year. Not convinced that they can do that, as you have a lot of competition in that space that'll probably drop their prices as well. Now, those are the poor performing stocks. On the flip side, you have some stocks that absolutely outperformed over the past year after airing an ad on the Super Bowl last year. Near the top of the list, you have Google. Shares of that company up 35%. Squarespace up 38%. Dodge and Jeep both up over 47%. TurboTax, which is owned by Intuit, they probably will have a pretty good quarter or two as we head into tax season. those shares were up 55%. Booking.com, where you book a lot of travel, shares of that company up 58%. And Kia, another automaker, up 58%. But there was a group of four stocks that really outperformed after airing a Super Bowl ad last year. The first one was Amazon. Shares of the e-commerce giant up 67% last year. And I went back and looked at their ad, see if there was something special about it. And by many critics' takes, Amazon's ad last year, which featured a puppy dog and another dog essentially coming together in a family, was one of the highest rated and most memorable ads of the Super Bowl. Amazon also benefiting from this kind of cost-cutting strategy that they've been on over the last year, driving higher revenue, but also reducing their cost, really increasing their profits. Now, another company that really benefited over the last year was actually DoorDash. Ticker symbol Dash. Shares of the food delivery app was up 83% over the last year, as DoorDash is trying to prove that it's not one of these pandemic darling stocks like maybe like Zoom Video, and that it's actually here to stay. Probably some evidence that these ride sharing and food delivery apps are here to stay is Uber. Shares of the rideshare giant were up an impressive 102% over the past year, as the CEO and the executive team over at Uber has done just a fantastic job, not only diversifying their business away from just the traditional ride sharing business, but also doing a great job capturing market share away from competitors, particularly Lyft. Now, the number one and undisputed leader in terms of running an ad on last year's Super Bowl and having it parlay into stock performance over the last year, drum roll please, actually has very, very close ties to sports, and in fact relies exclusively on athletic events being played in order to be making money. And that is DraftKings, the online daily fantasy and sports book website, ticker symbol DKNG. Shares of that company up an impressive 159%, as DraftKings has long lost money but are starting to reach kind of a tipping point in terms of profitability. They've also been expanding away from just traditional daily fantasy into legalized sports betting after that became legal across more states other than Nevada. And while DraftKings ad last year featuring Kevin Hart was very low rated and not very memorable, certainly people have continued to gravitate to DraftKings products, and certainly among FanDuel, MGM, and others, it is one of the major players in the online sports betting market. Seems only fitting that the biggest benefactor of running an online Super Bowl ad last year was an online sports book. We'll see what happens over the next year. Hopefully you guys enjoyed today's video, and if you're like me, you're going to be sitting on that couch on Sunday, and you're not only going to be watching the game and the competition, but also the advertising as well. And we'll certainly come back next week, see if any companies have made any waves and garnered a little bit more attention based on their ad. Hopefully you guys enjoyed the Super Bowl. I'll see you again next week, and good luck with your investments.